Welcome to the deep dive. We take complex stuff, sift through it, and boil it down to what you really need to know. Today, we're diving into, well, it's a foundational accounting topic, but honestly, it trips a lot of people up. We're talking about converting financial data from cash basis to accrual basis. If you're studying for the CPA or you're in intermediate accounting, maybe just dealing with small business books, you probably know this one can feel like untangling spaghetti. But here's the thing, getting a handle on this. It's not just about passing an exam, though. Yeah, it's definitely key for that. It's really about understanding the true financial pulse of business. Think about like small firms, a local doctor's office, maybe a design studio, your corner bakery. So many start out using cash basis. It's simple, day to day, right? But then what happens when they need a loan? Or they want investors? Or they just need a clearer view of their actual profit?
That's exactly when accrual accounting becomes, well, essential.
Yeah. So our mission today is to break this conversion down, make it simpler. We want to get into the logic so you're not just like memorizing formulas. We want you to really get why these adjustments happen, give you the tools to turn those cash numbers into a clear financial story. Okay, let's unpack this. But first, before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All the content, examples, explanations, everything we talk about today, it's derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, a CPA candidate, or already a professional, you should check out the website for extra practice questions, video lectures, and detailed support to really lock in today's topic. Special thanks to Professor Farhat for providing this great material.
All right, so uh, maybe the best place to start is just defining the two approaches clearly. First up, cash basis accounting. Honestly, it's probably how most of us handle our own money, right? Revenue. You only count it when the cash actually lands in your hand or, your bank account. Expenses. Same deal. You only record them when you physically pay the cash out.
Super intuitive. Cash in, cash out. Simple.
It is. But that simplicity, well, that's also its weakness for business reporting.
Right. Because it doesn't always show what's really happening performance-wise. Which brings us to accrual basis accounting. With accrual, it's different. Revenue is recorded when you earn it. Doesn't matter when the cash shows up. So you do a job today, provide that service, you record the revenue today, even if the client pays you next month.
Exactly. And expenses follow the same logic. They're recorded when they are incurred, meaning when you actually use the service or get the benefit, not necessarily when you cut the check.
Like your electricity bill example. You use power all month long. That expense belongs to this month, even if you don't get the bill or pay it till next month.
hmm It's all about matching. Matching the revenues earned in a period with the expenses that help generate them in that same period.
Which paints a much truer picture, doesn't it?
What's fascinating here is, yeah, it gives a far more accurate view of a company's financial performance over time.
Yeah.
The economic reality, not just the cash flow ups and downs. That's why it's required for public companies and, frankly, preferred by most banks and investors.
And for you listening, if you're prepping for the CPA or working with small businesses,
Understanding the why you're making these conversions from cash to accrual, that's so much more powerful than just memorizing a formula. Because understanding sticks with you, especially under pressure. It lets you see the story the numbers are telling.
I completely agree. And that why is exactly what we want to focus on. So let's make this real. Let's imagine Sarah from Sarah's Sparkling Cleaners. Okay. She's been running her business cash basis, but now she wants to grow, maybe get a loan, and the bank wants accrual statements. So first, big job, take her cash receipts and figure out her accrual revenue.
And usually, the two main accounts you'll need to wrestle with here are accounts receivable and unearned revenue.
Yeah. And the core idea, really, for all these conversions, it boils down to asking, like, two key questions. Did we get cash for something we haven't earned yet, like a prepayment? Or did we earn something, do the work, but we haven't gotten the cash yet?
Spot on. Understanding those timing mismatches is everything. Okay, let's tackle the first one. Accounts receivable, or AR. This is an asset, right? It's money customers owe Sarah for cleaning she's already done. So when we're converting cash receipts to accrual revenue, this sort of general formula looks like this. Cash receipts from customers minus beginning accounts receivable plus ending accounts receivable equals your accrual basis revenue.
Okay, let's break down that logic. Why subtract the beginning AR?
Well, think about it. If Sarah had receivables at the start of the period, say January 1st, that means she earned that revenue, did that cleaning job back in the previous period, like last December. The cash might have come in this period, in January, but the earning happened last year.
Ah, so it was already counted as revenue back then.
Exactly. So to find this period's accrual revenue, we have to pull that old cash out of the current receipts. It doesn't belong here.
Okay, that makes sense. So then why add the ending AR?
Because ending AR represents revenue Sarah earned during this period. She did the cleaning, but the cash hasn't arrived yet. Since she did the work this period, that revenue absolutely belongs to this period's accrual total, even if the payment comes later.
Right, it reflects work done now. Got it. Okay, let's put some numbers on Sarah's business. Say her cash register shows $110,000 in receipts for the quarter. At the start of the quarter, her AR was $22,000. And by the end, it dropped to $15,000.
Okay, plug it in. $110,000 cash,
Minus the beginning $22,000.
plus the ending $15,000.
That gives us $103,000 in accrual revenue,
So what did that tell us? Her AR went down by $7,000.
meaning she collected more cash this quarter for old jobs done last quarter.
Then she generated in new receivables for work done this quarter. So her actual earned revenue for this quarter is a bit less than the cash that came in.
Interesting. Okay, that clarifies AR. What about the other piece, unearned revenue?
Right. Unearned revenue. This one's a liability. It's cash Sarah received, but for cleaning she hasn't done yet. Like someone prepaying for a whole year of weekly service.
Ah, okay. So how does that formula look?
It's kind of the flip side. Cash receipts from customers plus beginning unearned revenue
Mm-hmm.
minus ending unearned revenue equals accrual basis revenue.
Okay, walk me through the logic again. Why add beginning unearned revenue?
That beginning balance represents cash Sarah got last period, but for work she hadn't earned then. The assumption is during this period, she probably performed that service, she earned it.
Ah, so the liability turns into revenue now.
Precisely. So we need to add that amount, which was earned this period, back into the calculation. It's revenue earned now from cash received before.
Okay. And why subtract the ending unearned revenue?
Because that ending balance is cash she received this period. But for work she still hasn't done. It's for future cleaning jobs.
So even though the cash came in now,
It's not this period's revenue. It belongs to the future. So we need to take it out of the cash receipts figure to get the true revenue earned right now.
okay, let's try Sarah's numbers again. Still $110,000 cash receipts. Let's say her beginning unearned revenue was $3,000 and her ending unearned revenue is $5,000.
All right, so $110,000 cash plus the beginning $3,000
Minus the ending $5,000.
equals $108,000 accrual revenue.
So what happened here? Her unearned revenue went up by $2,000.
Yeah, it means she collected $2,000 more cash this period for future work than the amount of past prepayments she actually earned off this period.
So $2,000 of the cash she received isn't really revenue for this period's performance. It's for next period.
You got it.
All right, I think we've pretty much nailed down the revenue side. Converting Sarah's cash in. Now let's flip to the other side, her expenses. Converting the cash she paid out.
Yep. And the key accounts here are usually prepaid expenses and accrued expenses or payables.
And it's the same kind of timing questions, right? Did she pay cash for something she hasn't used yet? Or use something she hasn't paid for?
Exactly that. Let's start with prepaid expenses. That's an asset. Things like prepaid rent, prepaid insurance, maybe cleaning supplies she bought but hasn't used. The formula here is cash paid for operating expenses plus beginning prepaid expenses minus ending prepaid expenses equals accrual expenses.
Okay, logic time. Why add the beginning prepaid?
That beginning balance is cash Sarah paid out last period for something she'd used this period, like maybe she paid her January rent in December or bought a year's worth of insurance last year.
So now, in this period, she's actually using up that rent or insurance coverage. It becomes an expense now.
Right. So we have to add back that portion of the prior period's payment that's being consumed or expensed in the current period.
Makes sense. And why subtract the ending prepaid?
Because that ending balance represents cash paid this period, but for benefits you'll receive in the future, like paying next year's insurance premium now or stocking up on supplies she won't use until later.
So even though the cash went out,
It's not an expense of this period, it's an asset for the future. So we pull that cash payment out to find the true expense for just this period.
let's do an example for Sarah. Say she paid $40,000 cash for insurance policies during the year. At the start of the year, her prepaid insurance asset was $10,000. By year end, it was down to $6,000.
Okay, so $40,000 cash paid plus the beginning $10,000 prepaid
Minus the ending $6,000 prepaid.
gives us $44,000 in accrual insurance expense.
Interesting. So her prepaid balance dropped by $4,000.
which means she used up $4,000 more of that previously purchased insurance this year than the amount of new future insurance she paid for.
So her actual expense for the year is higher than just the cash she paid out for insurance this year. She used more than she bought, essentially.
You've got it. Okay,
Okay.
last piece of the puzzle. Accrued expenses, or payables. These are liabilities. Expenses Sarah has already incurred, already benefited from, but hasn't paid cash for yet.
Like salaries owed to employees at the end of the month? Or maybe a utility bill that's arrived but isn't due yet?
Perfect examples. The formula looks like this. Cash paid for operating expenses minus beginning accrued expenses plus ending accrued expenses equals accrual expenses.
All right, let's break it down. Why subtract beginning accrued expenses?
Those were expenses incurred and recorded, accrued, back in the prior period. Think about salaries earned by employees in the last week of December, but paid in the first week of January.
Ah, so the expense belongs to December's work, even though the cash went out in January.
Exactly. So to get this period's expenses right, we need to remove that cash payment that relates to a prior period's expense.
Okay, then why add the ending accrued expenses?
Because that ending balance represents expenses Sarah incurred this period, benefited from this period, but hasn't paid for yet, like salaries earned in the last week of this quarter, or supplies used this month where the bill hasn't been paid.
So they are definitely an expense of this period.
Absolutely, even though no cash has moved yet. So we have to add them in to capture the full expense picture for the current period. She owes it now because she used it now.
That connects all the dots. Let's try Sarah's salaries. She paid out $300,000 cash in salaries during the year. At the beginning of the year, she owed $24,000 in salaries payable. By the end of the year, that liability grew to $36,000.
Okay, formula time. $300,000 cash paid minus the beginning $24,000 payable
Plus the ending $36,000 payable.
equals $312,000 in accrual salary expense,
So her salaries payable went up by $12,000.
which tells us she incurred $12,000 more in salary costs this year than she actually paid out in cash during the year.
Those extra hours worked, or maybe raises, they count as an expense this year, even if the cash follows later. She used more labor than she paid for during this specific time frame.
Precisely. And if we connect all these pieces, step back and look at the bigger picture, it's really important to remember that in the real world, or on an exam like a CPA simulation, these things usually don't happen one by one. You'll likely get a scenario with AR, unearned revenue, prepaids, and accrued expenses all mixed together.
Right, you have to convert the whole picture at once.
Yeah. But the good news is the core formulas, they stay the same. And more importantly, that underlying logic, understanding why you add or subtract based on timing, that holds true no matter how many accounts are involved. If you get the individual pieces, you can definitely put the whole puzzle together.
And that's really the key takeaway, isn't it? Armed with this understanding, you're not just, crunching numbers for a test. You're actually equipped to understand the real economic story of a business, to translate those day-to-day cash movements into a meaningful financial picture. It's about seeing beyond the bank balance to what's actually happening.
Which this raises an important question, maybe something for you, the listener, to think about. How much does that choice, cash versus accrual, really change the story a company tells about itself? Why do you think small businesses lean towards cash basis initially? And why is that switch to accrual so critical for, say, getting bigger or reporting externally?
Yeah, how does knowing this change how you look at a company's financial health? Is it just about the cash they have right now, or is there more to it?
Something to chew on.
Definitely. So we really encourage you, take these ideas, maybe revisit Sarah's examples, apply them to situations you know. True understanding, that real mastery, it comes from asking those why questions and really getting the logic. Thanks for joining us for this